Every politician loves a magic trick, a policy they can announce once, a number they can nail to the wall, and suddenly a chaotic economy looks stable, respectable, almost civilized. In the early 1990s, Argentina thought it had found that magic trick. 1 peso would equal $1. Always. No more runaway prices. No more salaries evaporating between payday and the grocery store. No more price tags changing twice a day. Just stability, order, and the comforting illusion that money had finally become solid again. For a while it worked. Inflation collapsed. The currency stopped being a joke. Foreign investors, who had sworn off Argentina after years of chaos, came rushing back. Shopping malls filled. Imported goods flooded store shelves. Politicians took victory laps on international stages. On the surface, Argentina had pulled off a miracle. It had tamed hyperinflation and joined the respectable club of serious economies. And then, almost overnight, the miracle turned into a trap. By the end of 2001, Argentina was in freefall. Banks were shuttered. Ordinary people were banging pots in the streets. Savings were frozen. The country defaulted on its debt in what was then the largest sovereign default in history. The same mechanism that had fixed the economy helped destroy it. So what actually happened? How did a country go from hyperinflation to apparent stability to catastrophic collapse, all under the banner of the same policy? And what does Argentina's experiment with convertibility really tell us about money, trust, and the danger of promises that look too good to be true? Collapse doesn't begin with riots and broken windows. It begins quietly, with exhaustion and a desperate promise. By the late 1980s, Argentina was drained. This was a society that had weathered military dictatorships, the terror of the dirty war, economic mismanagement, and then, in the 1980s, one of the most violent episodes of hyperinflation in modern history. Prices spiraled so fast that shops remade their price tags often. Paychecks were paid in cash and spent immediately because waiting even a few days meant buying less food, less medicine, less everything. Savings disappeared. Pensions were shredded. Contracts turned into jokes. Hyperinflation doesn't just destroy money, it destroys memory and faith. People stop trusting numbers. They stop trusting institutions. They stop trusting each other. A currency is supposed to be a shared language of value. In Argentina, that language had become nothing but panic. Money burned holes in pockets because it was safer to get rid of it than to hold it. So in 1991, the government went for something radical. The convertibility law. The idea was simple and seductive. 1 Argentine peso would be legally fixed to $1, 1-to-1, written into law. The central bank would only be allowed to issue pesos if it held an equivalent amount of dollars and other hard reserves. If the country had been living under a casino of money printing, convertibility promised something else, a vault. The peso would no longer be whatever politicians needed it to be this week. It would be anchored to the world's most trusted currency. If the 1980s had been chaotic, convertibility felt like order. And for people who had lived through that chaos, this wasn't just a technical policy, it was a psychological lifeline. Imagine watching your parents' or grandparents' life savings vanish 3 different times in your lifetime. Imagine getting paid and literally rushing to the supermarket because you know that by afternoon your salary buys less. Imagine a world where prices scribbled on cardboard boards are changed while customers are still standing in line. When you've lived through that, price stability is not just an economic variable, it's healing. Convertibility offered exactly that. Almost overnight, inflation plunged. Shops printed price tags that stayed the same for weeks and months. Long-term contracts started to make sense again. Mortgages, leases, loans, business agreements. Suddenly, people could write numbers into the future without feeling ridiculous. Foreign money poured in. The government privatized big state companies, sold assets, and paraded itself as a model student of free market reform. Imported goods filled the shelves. Many Argentines, especially in the cities, suddenly felt like they were participating in the same consumer dream they saw on American television. To a traumatized public, this did not feel like an abstract macroeconomic framework. It felt like a cure, a miracle, a promise that the ghosts of hyperinflation had been exorcised. But miracle cures usually come with fine print, and the fine print on convertibility was vicious. At its essence, a fixed exchange rate is nothing more than a promise. We will always give you $1 for 1 peso. It sounds neat, almost mathematical, but it quietly chains your entire economy to decisions made far away, by people you did not elect, in circumstances you do not control. By pegging 1 peso to $1, Argentina effectively imported U.S. monetary policy. When the U.S. raised interest rates, Argentina had to follow. When the dollar strengthened on global markets, the peso strengthened with it. When money flooded into or out of the United States, the ripple hit Buenos Aires whether Argentina was ready or not. The problem, of course, is that Argentina is not the United States. The U.S. has a massive, diversified economy, deep financial markets, and a currency that the world is willing to hold almost at any cost. Argentina, by contrast, relied heavily on exports like agriculture and basic industry. areas where competitiveness matters deeply. It had a history of political instability and far less room to absorb external shocks. A strong dollar might be tolerable for Washington. A strong peso tied to that dollar could be deadly for Buenos Aires. As the 1990s progressed, the US dollar strengthened. The peso, welded to it, followed. Argentine exports became more expensive on world markets. Neighboring countries with flexible exchange rates could adjust, devalue, and regain competitiveness. Argentina could not. At the same time, imports became cheaper. Foreign goods flooded in, pleasing consumers but bruising local industries that suddenly had to compete with products from stronger, more efficient economies. On paper, the currency looked strong. In reality, the economy was quietly losing blood. This is one of the great illusions of fixed exchange regimes. A strong currency doesn't always mean a strong country. Sometimes it means sharp edges hidden under a polished surface. Still, the illusion of strength has its own gravity. Ordinary people saw a stable peso and concluded, with some justification, that Argentina was finally behaving like a serious country. Politicians saw the inflow of foreign capital and declared the reforms a triumph. Banks, seeing the peg as a signal of stability, expanded lending and wrote contracts denominated in dollars. Underneath the charts and speeches, pressure built. The first test came from beyond Argentina's borders. In 1994, the Mexican peso crashed, triggering what became known as the tequila crisis. Investor confidence in emerging markets crumbled. Money that had flowed into Latin America began to rush back out in a classic risk-off stampede. Argentina, despite its reforms, got swept into the panic. Here's the problem with fixed exchange rates. They look safe in calm weather, but in a storm they can become cages. If Argentina had allowed its currency to float, a shock like that could have been partly absorbed by a fall in the peso's value, making exports cheaper and imports more expensive. Painful, yes, but an adjustment mechanism. Under convertibility, that mechanism was bolted to the floor. So instead of the currency adjusting, the real economy took the hit. Growth slowed, unemployment rose, small and medium businesses struggled. To defend the peg, the government doubled down on austerity to keep investors on side, cutting spending and squeezing an already fragile society. The central bank defended the peso with high interest rates and precious reserves. That was only the first blow. The Asian financial crisis in 1997 and the Russian default in 1998 shook global markets again. Money fled emerging markets, risk appetite shrank. Then, in 1999, Brazil, Argentina's biggest trading partner, devalued its own currency to regain competitiveness. Argentine exporters now faced a brutal reality. Their goods were priced as if they were made in a rich country with a strong currency, but they were still operating in a fragile, developing economy. Imagine being an Argentine manufacturer at that moment. Across the border, Brazilian competitors suddenly become much cheaper overnight. Your currency is pegged to the dollar. Your costs are in pesos that behave like dollars. Your customers aren't getting richer. Your loans might be in dollars that must be repaid one-to-one. You are playing a heavyweights game with a lightweight's frame. By the late 1990s, the structural weakness was visible to anyone who cared to look. Argentina was carrying a growing debt load, much of it denominated in dollars. The economy was stuck or shrinking. Unemployment and poverty were creeping upward. Social tension was simmering, and still the political class clung to convertibility, treating it not as a policy to be debated, but as a symbol of national dignity. Why not simply devalue and move on? Because devaluation is not just a technical adjustment. It is an admission that a sacred promise has been broken. Convertibility wasn't just a peg, it had become an identity. It was never again to hyperinflation. It was, we are now credible. Families had taken out mortgages in dollars. Companies had borrowed in dollars. People had deposits in banks in dollars, trusting the legal guarantee that one peso would always be as good as $1. To break the peg openly would have meant telling a country that had been scarred by monetary trauma that the miracle had been an illusion all along. It would have meant telling millions of people that the numbers on their bank statements were about to mean something very different. Instead of ripping the bandage off, the government tried to keep the illusion intact. It negotiated with the International Monetary Fund. It pushed through austerity packages. It engineered complex mega-swaps of debt, rearranging obligations to buy time. It showed the world every possible signal of discipline and seriousness. On the surface, Argentina was following the global rulebook: privatization, liberalization, fiscal restraint, central bank independence. But the arithmetic refused to cooperate. Debt was still rising faster than the economy. The recession was deepening. Unemployment was biting into the middle class. The number of people living in poverty was climbing. The cost of defending the peg was being paid in closed factories, falling wages, and frayed social safety nets. And ordinary Argentines began to ask the one question that threatens every rigid system. If this is the cure, Why do we feel sicker? When that question spreads from quiet conversations to public anger, trust doesn't fade gently, it snaps. By 2001, Argentina was running out of both dollars and patience. Investors, smelling risk, demanded ever higher interest rates to hold its bonds. The government, chained to the peg, could not inflate its way out, could not devalue without triggering legal and social chaos. Banks were deeply exposed, stuffed with dollar-denominated assets and deposits. The central bank's reserves were finite, and people, understandably, became afraid of being the last ones left holding the bag. Depositors began pulling money out of the banks, especially dollar deposits. Capital sought any path out of the country. The more people doubted the peg, the more they acted in ways that threatened it. This is the cruel logic of confidence-based systems. The fear of collapse can help cause the collapse. Defending the peg meant using scarce reserves to provide dollars for pesos and raising interest rates to try to keep capital at home. Those very defenses, in turn, strangled growth further, deepened the recession, and intensified social strain. It was a spiral, energized by fear. Eventually, the government did something that made the truth unmistakable. It froze bank withdrawals. Ordinary people could no longer freely access the money they believed was safely theirs. The corralito, the little corral, had arrived. The reaction was explosive. Argentines flooded the streets, banging pots and pans in spontaneous protests. The sound of metal on metal echoed through neighborhoods as a kind of urban alarm bell. People chanted, "They all must go," directing their fury not just at one politician, but at an entire class of leaders who had promised stability and delivered paralysis. Political chaos followed. Presidents resigned in rapid succession. Governments fell. As the crisis unfolded, Argentina defaulted on its debt. The peg was finally abandoned. The peso plunged. Dollar deposits were forcibly converted into pesos at rates that punished savers and ordinary citizens. Contracts written in a supposedly solid currency were rewritten by decree. The miracle ended not with a gentle adjustment, but with a brutal reset. The promise that had once calmed a traumatized country ended in broken glass, tear gas, and another deep scar on the collective memory. Who paid for Argentina's convertibility experiment? Not everyone paid equally. During the boom years, those closest to credit and capital did well. Politicians enjoyed rising popularity. Big businesses benefited from access to foreign financing and cheap imports. International investors earned high returns in a country that wore the costume of stability. Consumption boomed in certain areas. It looked like progress. When the reckoning came, the losses fell hard on others. Middle-class families saw their savings frozen, converted, and devalued. Small business owners were crushed by debt in dollars and revenue in devalued pesos. Workers lost jobs. Pensioners watched their modest incomes shredded by inflation. Everyday life was rerouted around scarcity, uncertainty, and anger. As with most crises, it was a transfer from those who trusted the system to those prepared to navigate its collapse. From people holding paper promises inside the country to those holding real assets, foreign accounts, or the ability to move capital and themselves across borders. The system defended itself by sacrificing its most trusting participants. It is tempting, looking back, to reduce this to a story of corruption, incompetence, or uniquely Argentine mismanagement. There was corruption, there was mismanagement, but that is not the whole story. Convertibility failed because it tried to turn something that must be flexible into something rigid. Money, in practice, is how a society absorbs shocks. Exchange rates move, interest rates change, inflation rises and falls. None of that is pleasant, but those adjustments are how pressure is released. They are safety valves. By bolting the peso to the dollar, Argentina welded several of its own safety valves shut. It accepted a trade, flexibility for credibility. In the short run, that trade looked brilliant. Inflation collapsed, confidence returned. Growth, for a time, surged. In the long run, it meant that every external shock, every internal weakness, had to be absorbed somewhere else, in wages, in unemployment, in cuts to public services, and eventually in social peace. A fixed exchange rate is like a bridge built without flexible joints. It may look solid, it may feel reassuring underfoot. But when the first serious earthquake hits, you discover whether it can bend or whether it snaps. Argentina snapped. If this were only about a single country in a single decade, it would be a sad but contained story. But Argentina's convertibility fits into a much larger pattern. You can see its echoes in the gold standard, where countries refused to abandon their fixed link to gold even as unemployment soared and social unrest rose, until the system finally broke. You can see it in other currency boards and pegs from Southeast Asia to Eastern Europe, where defending the promise drained reserves, choked growth, and ended in collapse. You can see shadows of the same dynamic in the Eurozone, where countries share a currency but not a full political and fiscal union, and where crisis-hit nations cannot simply devalue to regain competitiveness, so their adjustment comes through deep recessions and painful internal cuts. Each time, the story rhymes. A promise is made This time, we have removed politics from money. This time, the rules are clear, automatic, and neutral. This time, credibility will protect us. For a while, it seems to work. Then the world changes. Crises hit. The rigid rules clash with messy reality. Leaders insist the system is sound. Citizens feel the pain and start to doubt. Belief erodes, and when belief vanishes, the elegant architecture of fixed promises collapses under its own weight. So what survives when a promise like convertibility fails? Not slogans about stability, not legal guarantees carved into statute books, not speeches about discipline and responsibility. What survives are the same things history has favored in every collapse: real assets instead of paper claims, flexibility instead of rigidity, the ability to adapt when rules are rewritten instead of betting your future on those rules, never changing. For ordinary people in Argentina, the bitter lesson was simple. A fixed number does not equal real security. A calm exchange rate does not automatically mean a healthy economy. And a system that can freeze your savings to save itself will always value its own survival more than your balance. For the rest of the world, Argentina's convertibility is not an exotic anomaly. It is a warning written in quiet bank lines, loud street protests, and a currency board that worked perfectly until the day it didn't. Be cautious of any policy that promises permanent stability in a world that is inherently unstable. Be skeptical when leaders say, "We finally found the formula, just trust the system." Because the system may function beautifully for a season. It may feel like salvation. It may impress foreign investors and comfort domestic voters, until the day the pressure builds beyond what the rigid structure can bear. Until the day belief breaks. Until the day the magic trick ends and people are left staring at the bill. When that day comes, the important question will not be whether the peg was intellectually defensible or whether the reforms looked clean on a spreadsheet. The question will be who is left holding the promises and who quietly arranged their life so that they hold something real. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.